Dynamic modeling techniques for effective asset liability management in banks. In the fast-paced world of banking, managing assets and liabilities effectively is crucial for financial stability. Dynamic modeling techniques have emerged as powerful tools to enhance asset liability management, or ALM. Let's delve into some of these techniques and their significance. Understanding asset liability management. Asset liability management involves managing risks that arise due to mismatches between assets and liabilities. This includes interest rate risk, liquidity risk, and funding risks. Ineffective ALM can lead to significant financial losses, making dynamic modeling essential for banks to navigate these challenges effectively. Duration gap analysis. Duration gap analysis is a foundational technique in ALM. It measures the sensitivity of a bank's assets and liabilities to changes in interest rates. By calculating the duration of assets and liabilities, banks can determine the duration gap. A positive duration gap indicates that the bank's assets are more sensitive to interest rate changes than its liabilities, which can lead to losses in a rising interest rate environment. Conversely, a negative duration gap suggests that liabilities are more sensitive, presenting risks in a declining rate scenario. Regularly monitoring and adjusting the duration gap allows banks to create a balanced position and manage interest rate risks effectively. Scenario analysis. Scenario analysis involves assessing the impact of various potential future states on a bank's balance sheet. This technique examines how changes in economic conditions, interest rates, or regulatory environments could affect assets and liabilities. By employing scenario analysis, banks can simulate different market conditions, such as economic downturns or changes in monetary policy. This helps banks identify vulnerabilities, allowing for proactive adjustments to their ALM strategies. Scenario analysis not only enhances understanding of potential risks, but also fosters informed decision-making. Monte Carlo simulation. Monte Carlo simulation is a sophisticated technique that uses random sampling to model the behavior of portfolio returns and risks. By generating thousands of potential future scenarios for interest rates, exchange rates, and other factors, banks can assess the probabilities of different outcomes for their asset and liability positions. This technique provides a comprehensive view of risk exposure and helps banks quantify the probabilities of unfavorable outcomes. It allows banks to create risk mitigation strategies based on the likelihood of various scenarios, refining their ALM processes. Liquidity modeling. Liquidity modeling is vital for understanding a bank's ability to meet its short-term obligations. Dynamic modeling techniques assess cash flow projections under different scenarios to ensure liquidity is maintained. Banks can create liquidity models by analyzing historical patterns in cash flows, customer behaviors, and market conditions. By simulating cash inflows and outflows under stressed scenarios, banks can identify potential liquidity shortfalls and take measures to mitigate risks. Stochastic interest rate models. Stochastic interest rate models account for the randomness of interest rates over time. Unlike deterministic models, these dynamic models consider time-dependent changes and uncertainties in interest rates. Using stochastic models allows banks to understand how different interest rate scenarios affect their asset and liability pricing. This is particularly useful for assessing the value of fixed-income securities and ensuring that pricing strategies align with market expectations. The importance of technology. Implementing dynamic modeling techniques involves advanced analytics and modeling software. Banks are increasingly adopting technologies such as AI and machine learning to enhance their modeling capabilities. These technologies improve data accuracy and allow for faster, more efficient processing of complex models. Conclusion. Dynamic modeling techniques play a crucial role in effective asset liability management for banks. By leveraging methods such as duration gap analysis, scenario analysis, Monte Carlo simulations, liquidity modeling, and stochastic interest rate models, banks can navigate the complexities of modern finance. As the banking landscape continues to evolve, adopting these dynamic approaches will not only enhance risk management, but also promote financial stability. Staying ahead in the game requires banks to continuously refine their ALM strategies using innovative modeling techniques. Ready to elevate your treasury expertise? Become a Global Banking Hub member to access exclusive courses, earn certificates, and get personalized feedback. Join now at www.globalbankinghub.com.